Hello, and welcome back to the continuing lecture in uh, tax computation. This is Dr. Jeff Hong, and we are uh, into the third video in this topic. So in our last video, we left off, we wrapped up pretty much everything about the income tax, earned, income tax, and then we left off with the right before calculating the tax on the dividend income. And the rule, as I've been telling you, the rule used to be if your marginal tax bracket is under 25%, you don't pay any taxes. But if you are falling into above 25% marginal tax rate, then you pay 15%. Okay, that used to be the rule. Now, but after, right, if you are above 25% marginal bracket, marginal tax bracket, marginal tax rate, so that tau, that's Greek character tau, which stands for tax rate. Now, and I explained what marginal tax rate is. And then, but in 2018, the tax schedule changed. So there's no more 25% bracket. So then I would, and also the rate that you pay if you're above 25%. So roughly, I would say now it's 24% bracket that would, right, that has replaced this 25% bracket. So if you're above 24% marginal tax bracket, then you pay 12%, not 15%. So think about it. This is clearly favoring capital income or investment income, right? Capital income or investment income, because, and as I said before, most wealthy, people, like, top 1%, 0.1% wealthy people, their income is mainly capital income or investment income, not labor income or earned income, right? So then if you're just above 24%, look, 24% bracket is up to, 350,000. Now there's a 24% bracket. And people in the upper top 1% would be making like more than, 50, at least 50, 0.5 million or 500K a year. I mean, and in the really, like, 0.1%, they would be making, billions a year, right? So they would all fall above, 24% marginal bracket, and then marginal rate bracket, and then they will only pay 12%, not even 15%. 15% is already, quite preferential rate for the wealthy. top 1% wealthy. And then even the people who make like, above 165 and, between, 165K and 315K, relatively, they would be at least, somewhere between top 10% to top 1%, right? Between top 1% and top 10%. Anyway, so our question is, how do we make it automatically determine? How do we make Excel automatically determine whether the point is whether you are in the whether your marginal rate falls into above 24 or below 24, right? Or up to 24, right? And so to do that, as I said, it's pointless if you are just looking up this, and I'm, currently I'm in, my taxable income is this, so I'm in this bracket. My incremental income, if I make, another dollar, I will still fall into this until, so in other words, until my taxable income is 165, my marginal rate doesn't go into the 24%, right? For me, my marginal tax rate is 22. So then I won't be liable. I won't be subject to paying this 12%, right? I won't be subject to paying this 12%. That's good. And determining this by you, that's fine. I mean, it will work for only, but then this type of, with this type of, model getting you involved every time, then, it cannot be automated. It will be you will have to get involved every time to make that decision. But that's not the purpose of, doing it on Excel, right? If you're doing it by Excel, you have to make Excel determine that on its own. All you need to do is just provide data and logic, right? So the data is provided, and so you provide logic. The logic I provided is here. So now think about it. B17 is our taxable income, right? And then what is marginal? What does marginal mean? If you're making one more dollar, right? Additional incremental, one more dollar. And whatever this may be, if you're making one more dollar and if it falls into the next bracket, then you pay, right, 12% on that. Otherwise, 0. So that's the logic here, right? You add one more to your taxable income. And if it is still below D23, what's D23? This is D23, right? That's the upper bound. That's the upper bound of the 24. So it has to be, I would say, because that is the upper bound of the 24% bracket. Because, as I said, previously it was 25%. If you're above 25% marginal rate, you pay, 15% on that. But now there's no 25, so I'm assuming what replaced the 20% bracket would be 24%, and the upper bound for that is this. So as long as you don't cross over, right? As long as you don't cross over this upper bound, then you would pay 0. Right? Understand? If you're making, by making additional dollar and increasing your taxable income by additional dollar, if you're still not exceeding this, you pay 0. Otherwise means you're exceeding that, then you would be paying 12% on that dividend income. So here, by doing this, it's going to automatically determine whether you're going to be, and we know our marginal tax rate, even going to 24%, is still, even if you're making another dollar, you will still be here, 22%. So you don't pay any on that dividend income, right? Makes sense? There you go. So it automatically picks 0, right? Dollars, right? I forgot to put a dollar sign there. Okay, dollar, 0, right? Nothing. So next, so what is your total tax? Of course, then total tax will be the sum of everything, right? Sum of all of these, right? Next question. We know what the marginal tax rate is. Marginal tax rate, we do the same thing. B17, we try adding, just one more dollar to B17. And if it is below, still the upper bound for 22%, right? And then still it is 22%. If it is above that, if it is, otherwise, that means it's above that, then you would fall into 24%. So it's going to automatically pick 22%. Your marginal tax rate is still 22%. And I told you that Greek character tau stands for marginal tax rate, right? Greek tau is for t, so what would that mean? It would be a symbol for tax rate. Now, and then what is the average tax rate? So average tax rate is the average of these, right? Effective. It's also called effective tax rate. So let me also. Average tax rate or effective tax rate. So you might say, oh, so I take the average. No, look. It is weighted average. It is weighted average, not the. It's weighted average, not simple average, because all the amounts, dollar amounts that fall into each bracket is different. So you cannot use simple average. You have to take the weighted average. So taking weighted average means, and also you can do it this way. B37 is the total tax amount, right? Total tax divided by B17. B17 is your taxable income. I mean, that will give you straightforward, right? What your tax rate is, average tax rate is, because that's the tax you pay on your taxable income. And I would also put, I would also lock B17 because B17 is our taxable income. But also, so actually you're paying much less than your top tax rate, because previously you might have thought, oh, because your income falls, taxable income falls in this range, so you must be paying, 22. No, actually, by going through all of these, right, you are making, you're effectively paying much lower, right, than your top tax rate. All right, so that's what the, that's the example of the personal income tax case. Now I want to move on to the corporate income tax example. I'm going to come back to later, the average, right? Which can be done also by this times this, this times this, this times this, this times this, right? Let me quickly. Uh, uh, is a bit, I'm going to come back to this later. This is not the, it will take some time to explain. Now, next is corporate tax example. Now, let's take a look at this example. Actually, the personal tax example is exactly the same thing in the PowerPoint. If you go to, I don't want to switch between, but if you go to slide number 42, example 2.1, Joe and Sue with combined gross income of their earned income, combined earned income is 107K, right? That example is the one in the our slide, or also in the textbook, right? I just did it on Excel. Now our next example, corporate tax example, is slightly different because the one in the slide and the one in the book is wrong. The example they used there is wrong. So I'm borrowing this example from another course that I'm teaching. Actually, we don't go too much into tax in principles of finance. The Connect had an example on corporate tax. So here, let's take a look at this example. The Dakota Corporation had a 2015 taxable income of 31,500,000. So that's from operation after all operating cost, but before interest charges of interest charges of 8.4 million and dividends. So before you read everything, right? First, what does this mean? They have taxable income of 31 before interest charges. So that means that's EBIT, right? Think about it. Income, right, from operations. That means you have income minus expenses, which is CGS, and operating expenses after all operating costs. So after operating expenses. So that's EBIT. And it's also saying before interest charges of 8.4 million. So it's before interest. So 31.5 million is EBIT. Okay. Now, and they also received dividends of 740K. So dividend 740K. Now, dividend income is, of course, taxable. And you remember, it will be taxed at 15%, 12%, after 2015. But here's a rule about dividends received by a company, by a business, by a corporation. Unlike the dividends received by an individual, right? Uh, corporations invest in another corporation, right? And receive dividend income from another corporation, depending on how much shares they are, how much share they have in another corporation. The taxable amount or the total percentage of that dividend income is different, right? Generally, so here's the here's the rule. So I will have to switch, the file. So for applications, so here, I'm switching back to, okay, so I hope everyone is able to see. I believe you can see this now. Okay. So dividends paid to one corporation from another corporation, right? Dividends paid to another corporations are partially tax exempt. So in our example, let's call the company our Dakota. Our example is so if Dakota owns Dakota bought their stocks shares of let's say company X. And what was the name of it? It doesn't matter. Let's call it X, company X. But just to make sure, let me check if they receive dividends. They didn't say the dividend of which company, but so from company X, they receive dividends, and the ownership of if the ownership share of Dakota company X is less than 20%, 70% is exempt from 70% is exempt from taxation. That means they only 30% of that dividend is taxable, right? only 30% of that is taxable. Doesn't look that pretty, but okay. And if the ownership is, between 20 and 80%, 80% is exempt, so 20% is taxable. If the company owns more than 80%, Dakota owns more than 80% of this company, then 100% is taxable. Of course, we don't have any information. We don't know if Dakota owns more than 20% or not. But usually, the ownership is, in a large corporation is well distributed and well diversified. Nobody has such a huge concentration above 20% generally. Of course, in cases, in case of a joint venture, if a company is a joint venture of company X and company Y, and there's a company A, which is a joint venture of X and Y, then funding comes all from X and Y in any kind of proportion, but most likely, something like 40-60, 50-50. But anyway, in general, so I would assume that the ownership of Dakota in ownership share of Dakota in company X is less than 20%. So I'm coming back. I should be coming back to okay. I should be coming back to the Excel file. Okay. All righty. So I would assume that they don't own more than, right? So okay. So I would say they are, dividends are taxable. Only up to 30% of that would be taxable. If it is only up to 30%, 30% of that will be this. So that's the taxable dividend. And then the interest is this, right? That was already, set by the initial conditions. So what would be our earnings before taxes? It would be the difference between this and this. This would be our EBT, but you might wonder, don't we have to also include? Yes. So if we include, also the dividend, right? I'm sorry. So the EBIT plus taxable dividend, right? And then if you subtract, interest from that, our EBT will be this, right? But you might wonder, why don't I include it there? Listen, remember, dividends are taxed at different rate, right? Depending on your marginal tax rate. It also applies to corporations. But no matter what, dividend will be taxed only at 12%, right? Or 15% or 12%. So I cannot include it into the, because this is corporate income, right? And this is dividend investment income, right? Corporate income is like, earned income of an individual. So I had to separate it. of course, EBT with dividend, taxable dividend is this. Without taxable dividend is this. And so I already have filled in everything, but the way it works, and now you should be more comfortable with this. This is 2018 corporate tax bracket, and apparently it didn't change. Corporate tax bracket, corporate tax schedule didn't change much from 2006. Now, interesting thing is, they don't go through every bracket like in the income, personal income. In corporate taxes, you go straight to where your taxable income belongs to. So in other words, our taxable income is this. This is our taxable income, right? Let me use, okay. So you find where it belongs, right? Instead of going through every tax bracket, you go straight to, so this company made taxable income is 23 million, 23.1 million. So you are above, you're in the rate, right? So all you need to do is, if you're in the top rate, and for any bracket, you're in the top bracket, but suppose your taxable income was somewhere here. Somewhere there would be, suppose, between 335K and 10 million. Say, what if it was 5K? I mean, 5 million. Okay, if it was 5 million, what you would do is, because it falls here, right? 5 million falls here. For every bracket, there is a base amount. Base amount. So you pay the base, right? And then 4%, in that case, you're subject to 34% tax rate. For anything above that base amount, right? So that means you will subtract the base amount from 5 million, and then to that difference, you multiply 5 million, okay? So, but if we do it, because we're doing it on Excel, our point is, we want to make Excel automatically do that, right? We'll have to compare, this taxable income with, whether, every bracket, and it should automatically determine whether it belongs to this bracket, or this bracket, or this bracket. So we're gonna do that in the next video. Okay, so that's it for this segment of the lecture, and I'll see you guys in the next video. Stop recording.